everybody, Wendy Zapata, NorCal Financial and Insurance Solutions. And today I want to do a little market watch with you and talk about the market trend, which is indexing. It is not a new concept. It is not new to the industry. However, it is being more and more used due to market volatility, and we also have an upcoming election. So what exactly is indexing? So indexing is very simple. It's an investment strategy which attempts to mimic the performance of the market index. An index is a yardstick, and a market index is a group or a basket or a portfolio of securities selected to represent and reflect a market as a whole. So therefore, a passive strategy, because it does not involve either security selecting or trading, this is very safe. The basket or portfolio of securities defined by the index is purchased and held indefinitely. So basically, what indexing is it is something that mirrors what the stock market is doing, but when the market goes down, the index stays flat. There's no loss. And when the market goes up, there may be a ceiling or a cap on the earnings. It is a very, very nice way for long-term investing. So what are popular indexes? The most popular is going to be the Dow Jones, which is composed of 30 large U.S. industry companies. Most of us know what the Dow Jones is. We just don't know how it works on the insides, right? And so also, the biggest market that the indices are traded on, or not traded on, but based on, is the Standard & Poor's S&P 500. So the logical argument for index funds seems very simple because it's composed of either passive or active investors. On average, the performance of passively managed portfolios match the performance of the market. On average, the performance of actively managed portfolios must therefore match the performance of the market, which means if you're passive, you're not going to be included in those losses, all right? If you're active, then you may be actively losing and actively gaining. If you're passive, like I said, you may not be losing or gaining at any time. You may just be going flat until the market corrects itself. So one of the things that I can tell you that I love about the indexing, and we do in our company fixed indexed annuities, and then also indexed universal life, which both are in the indexes, and in the case that everything we do is safe. It is incredible to be able to sit with someone and say, look, the market is very volatile, and if this is something that bothers you and you don't like uncertainty, or you don't want to wait for the market to come back, then this is something that we need to look at, and let's look at the potential growth. And we can actually see that in some charts that I can show you, okay? So it really is the best of both worlds. Recently, a number of fund companies have developed so-called super index funds. These are funds which purport to outperform the index by manipulating the relative proportion of securities in the index. Where they are promoted as funds which merely enhance the benefit of passive investing, the reality is that they are actively managed, since the manager must necessarily make decisions about which sectors or securities should be emphasized. As a result, they are more about the market appeal of indexing than they are about the merits of passive investing. So a final note on this is it is just at a root, index funds essentially are the goal to outperform the market in favor of nearly matching it, okay? So that is the goal. We want to make sure that when you are in certain indexes that you are mirroring what the market is doing. However, once again, when the market does this, you're just going to stay flat. And that is the goal. in safe investing, conservative investing. So that's a little bit about indexing, and have a great day.